Afternoon and welcome to a special edition of Biztech ASEAN Midday Marketwatch. On the last day of the year, we have two special guests, Halley, Senior Market Analyst, Asia Pacific at OANDA, and David Kuo, founder of the Smart Investor in Singapore. Gentlemen, thanks for coming on the show on the last day of the year.
Well, thank you, Brian. I feel very underdressed. I noticed that the two of you are wearing shirts and ties, right?
Well, I thought about it very closely about whether to wear a tie today. I just threw it on.
Yeah,
Don't feel bad.
So did I. I said, let me keep the look consistent since I've been doing this for the last few months.
You get a clip-on. Should get a clip-on tie, actually.
I tell you what, Brian, I nearly wore a shirt that looks like the background of your screen there. Yeah. That's impressive.
Well, you know, in the era of Zoom, my pants look like the background. that's on, that lovely painting in my background, actually.
Yeah. That could be the investment outlook for 2021, that painting.
Yeah. Right. Well, before we get your sagely advice, gentlemen, let's take a look at how markets are trading. Some markets have already closed in this part of the world. And if we look at the Nikkei, and just wait for it, the Nikkei is down 0.45% at 27,444.17. The Shanghai Composite is up 0.83% at 3,442.79. The Hang Seng, which is closed now, is 27,231.13. It's up 0.31%. ASX 200 has also closed down 1.43% at 6,587.10. The Kospi is up 1.88% at 2,873.47. And if we look closer to home, the Singapore Exchange, and if you just give me a second, is closed at 2,843.81. It's down 0.89%. And just give me a second, I'm trying to get a hold. The internet is considerably slower today.
I could probably help you out, Brian.
Yeah, could you help me out, mate, with what the Bursa Malaysia is trading at?
The Bursa Malaysia today is down 0.54%.
Thank you very much, mate. So, gentlemen, now moving on to your thoughts. Jeff, what do you reckon on the last day of markets? What are your thoughts on what trading is like?
Well, we've seen a bit of a split here. I will point out that you made a little error that Japan and South Korea are closed today, but I'll put that down to internet issues. So, yeah, that's nothing like being backwards looking. China has rallied today after a moderately positive session in the States, but also Chinese PMI data, non-manufacturing and manufacturing PMI data came out very, very strong, still very expansionary. That's lifted sentiment in China, which is also seeing a bit of a tech comeback in the last two sessions as well. Elsewhere across Asia and Asia Pacific, it looks like investors are taking some risk off the boards, maybe locking in a few profits, reducing exposures ahead of the long weekend, and that's why we've seen these Asian markets, regional markets, all ease. It's further complicated in Australia, where the concerns are mounting about the COVID-19 outbreak in Australia, and that's been weighing on Australian equities this week. So, yeah, China steaming along as usual. The rest of Asia somewhat more circumspect as we head into the holiday break.
Now, over to you, David. 2020 has just been a year that for many people, they would just like to write off. For the stock market, however, it has been for many markets Boomtown Charlie. But what is your personal view on how we should view 2020 from a point of view as an investor in this part of the world?
Okay, thanks, Brian. Now, I just want to point out that whilst you were reading out all those data index moves on the very last day, I had absolutely no interest in that whatsoever. Simply because
I knew he was going to say this.
Simply because I am a long-term investor. I tell you what, I almost treated it like a commercial break on the movies, and I was going to go and get myself a cup of tea and then come back, and you still be rattling off how all those indices have been doing. Now, as a long-term investor, you got to stick to your principles, and I think that was my lesson to a lot of people in 2020. If you are an income investor, then just stick to becoming an income investor. And if the shares that you are interested in, shares that you own, have fallen and the yield looks good, go ahead and buy them. If you're a growth investor, well, go ahead and buy those as well. And I think that really is the lesson for 2020. If you had done that and taken advantage of the slump in the market and packed in more of the shares that you wanted to buy but couldn't buy because you thought they were a bit expensive, that would have been a good buying opportunity. And then when you look back now at what happened around sort of March time, hey, you'd be laughing all the way to the bank. And talking about banks, I mean, bank shares have fallen quite significantly, and it was a good buying opportunity. Sure, some of the banks, like the UK banks, had to withhold their dividends. They had to press pause on the dividend payments, but they'll be resuming their dividends in 2021, hopefully. So therefore, for me, it was almost like an aberration, 2020, and it was a nice aberration for those people who were prepared to stick to their principles.
Now, Jeff, on your side, what are the key lessons that we should learn about this year from an investment standpoint?
Well, firstly, I'm 100% aligned with David on this one. What I think is a very important factor to take away is the difference between trading and investing. And it's something that I've been beating the drum about all year. It's too easy to get caught up in the noise of the markets as an investor. And we've had a lot of noise this year, let's face it. It's important to understand that moving in and out of portfolios, be it stocks or commodities, on a very short-term basis is not investing. That's trading. And they're two totally different things. And investors should be looking to step out of that noise and looking towards the longer term. Secondly, we can't underestimate the power of monetary policy, and interest rates are at 0% all around the world with unlimited liquidity, it seems, flooding the markets. That has seen the search for any sort of yield in a 0% world push money into some very unusual parts of the market. Even junk bonds have been rallying aggressively this year as investors, particularly institutional investors, are desperately looking for any sort of yield to put in their portfolios. So we expect to see interest rates remain at zero for all of 2021, and I expect we're going to see much the same sort of price action that we've seen in 2020 through that time.
Now, David, over to you. As you mentioned, you're a long-term value investor. What are the key themes, trends, or stocks you'd be looking to add to your portfolio in 2021 that you think is going to be good long-term bets?
Okay, I think the global economy is going to recover. I don't think, I'm alone in saying that, and I don't expect to sound smart by saying that. I mean, we've been in the doldrums, and as Jeff pointed out, interest rates are going to be exceedingly low, which will give a lot of companies the opportunity to start growing and economies to start growing again. But unfortunately, I think there'll be a lot of people that will be left behind. For a lot of people, they'll hear the fact that, there is a recovery going on, but as far as their personal perspectives are concerned, there is no recovery because they haven't got a job to go back to.
Absolutely.
It'll feel like a recession, even though it isn't recession for them. And so for me, Brian, I think you have to treat the fact that, yes, on the one hand, there will be economic recovery, but on the other hand, a lot of people will still be in recession. And if you are in recession, and if you are one of those unfortunate people who are not enjoying the recovery, then I think as an investor, I would be focused on the things that people who can go out and buy things, but unfortunately, they won't be able to buy, the expensive goods that you need. And so therefore, this is where consumer staples come in. I'm very focused on consumer staples. And I think, the things that people need to buy on a regular basis, those are the ones, that I would be very focused on. It's the things that people cannot do without, and the things that people can really afford to buy. And so consequently, things like pharmaceuticals, I think, are things that people can't do without. And the things that people can afford to buy, a little bit of guilty pleasure once in a while, things like a Starbucks coffee. I think those are the kind of companies that I would be focused on, particularly those that have got good fundamentals as well.
David, when you talk about consumer staples, what sort of stocks are you adding to your portfolio, or accumulating maybe in 2021?
Okay, there are plenty that are listed in Bursa Malaysia, Brian, and Bursa Malaysia is one of those markets that I tend to gravitate to in times like this. I look at companies like Dutch Lady, I look at companies like Nestle's, I look at companies like Ajinomoto, for instance. A lot of people didn't even know that Japanese company was listed in Malaysia, but Ajinomoto is a great one. British American Tobacco, things like Heineken, Carlsberg. I mean, those are really great brand names that people here in Asia can buy quite easily on Bursa Malaysia.
And how about on the SGX?
Well, over on the SGX, you've also got a lot of consumer staples as well. Things like Dairy Farm is one company. They own cold storage supermarkets here in Singapore. You have to go and buy things. So if you want something a bit cheaper, you got Sheng Siong Supermarket, which is another one. Then you got Hall, for instance. I mean, they produce Chinese pharmaceuticals, and that is another company, that if you are in need of those kind of pharmaceuticals, those Tiger Balm or ointments on the days of when you have a headache and you need to actually rub something onto your temples. I mean, that is another great company. So there are lots of consumer staples. So just go and have a look, in the market. I've given you so many names. I mean, these are all inside my portfolio, and these are the ones that I would be more than willing to add to. And don't forget the banks as well. We can't do without the banks, unfortunately. So the banks will be resuming their dividends. Many of them have had, as I said earlier on, they've had to press pause on that for the moment. They can't pay as much as they did. But if you have a look at the bank profits, they weren't really half bad. So therefore, I think they will be itching to reward their investors and trying to get their share price up by resuming their previous dividend payouts.
And David, you've mentioned DBS Bank as one of your favorites in the past. Are there, besides DBS, is there any other banks in the region that you would be looking at accumulating?
Well, I have an entire portfolio that is packed full of banks. So within that portfolio, I have Singapore's largest, which is DBS. I've also got UOB and OCBC. Over in Malaysia, I've got Maybank and also Public Bank. And then apart from that, the two UK listed banks that operate here in Asia. Standard Chartered is one, and also HSBC. So I've got a lot of banks. But apart from the banks, Brian, I mean, the insurance companies look interesting as well. If the stock market's going to have a good year, then I think because the insurance companies have to invest their money in something in order to, as Jeff pointed out earlier on, to get a kind of yield on people's money that they've given them, then of course, the insurance company should do well. And particularly with COVID as a backdrop, I think what will happen is that people will be a little bit scared and they will be going out and buying their insurance.
Buying more insurance.
Well, exactly. So therefore, I think insurers will do well. And apart from that, I think, some of these card payment companies, things like MasterCard and Visa, I think they will do well as well because people are doing a lot of their shopping online. And these companies are not just credit cards. I mean, they are payment processors. And every time you make a transaction, they take a little bit of that fee. So therefore, I think they will do well. So there are plenty of opportunities in 2021.
Now, Jeff, over to you. What are the themes and trends and perhaps some individual stocks that you would be talking to clients about in 2021?
Well, when we look at the markets in Asia, for example, this year, North Asia generally has outperformed Southern Asia, or we call it ASEAN. Let's call it ASEAN. And I believe this is because the Northern Asian markets have a much higher what I call the working from home trade. They're much higher technology content, all those ancillary industries, and that's part of the reason why. ASEAN has underperformed because it is very heavy in sectors I described as not working from home, commercial property, as you said, banking, these very cyclic and commodity-based industries and utilities, stuff that's been really, really unloved in 2020. But with the global recovery, I'm expecting those sectors to actually outperform. So I'm expecting ASEAN markets, your Malaysias, Singapores, Indonesias, to outperform this year. I think Asia as a whole will grow this year quite substantially, but I believe that ASEAN markets will actually, by the end of 2021, have outperformed their much more glorified northern counterparts as they play this huge game of catch up. Like David, I'm a big fan of the banks. I don't think you can look past BCA, Bank of Central Asia, here in Indonesia, that have such a solid, huge market leadership position in this market of 300 million people. They really do. And if you're looking for a cornerstone equity to put in your portfolio in this region, then I think that's certainly one. Maybank, I agree with. Singapore banks as well. I think it's still too soon to get excited about airlines. It probably won't be for another few years, to be honest. So, yeah, that's when it comes back to trading versus investing. Investing in airlines, I don't think is going to be a great trade over the longer term.
Airlines has always been, from the time I was in universities, it was always about, the last place I'd put money into, because they're just so capital intensive, and that the return on capital is so poor.
Yeah, so airlines are a place to have a large fortune that you want to make into a small fortune. So that's the old adage anyway. But certainly some of these more legacy sectors that have been off the radar this year, they're very prevalent in ASEAN, and that's why I think these markets will outperform in 2021.
So any specific legacy sectors that think we should look to in ASEAN?
Well, I'm actually a big fan of the banks, actually, as David pointed out. And also, I'm a bit of a dividend investor as well. And one of the plays I thought, you could also look at things like transport as well. Things like, for instance, I guess sort of taxi companies or things such and such like. Yeah, I think they all, when the economies start opening again, that business is going to explode, and nobody loves these sorts of transport sector, public transport. Yeah, there's SPS and MRT in Singapore and other parts of Asia as well. So I'm very much in the camp that they will outperform or surprise everybody to the upside this year, 2021. Sorry.
Now, David, any final words?
Yeah, I love that term that Jeff used, which was unloved. There is a huge difference between unloved and unprofitable, right?
Yeah,
a lot
exactly.
of these companies are profitable, and just because they're unloved, it means that the share price is down. But focus on things like the cash flow and the profits that these companies are making. And if they are still generating a lot of cash flow and a lot of profits, then going back to those banks, they will be able to use some of that cash, some of that profits to buy back their shares, which therefore means that the share price will rise because the earnings per share will go up. And it will also mean that these banks have confidence in the future. And ultimately, the banks are very well capitalized. And all this talk, about a double dip recession and all that, these banks are really, really sort of quite strong at the moment. And they should never have been prevented from paying back, rewarding their shareholders with dividends. I think that was a big mistake by the regulators all over the world. They panicked, and they shouldn't have done.
Well, thank you, gentlemen, for your insights and time this New Year's Eve. And we've been speaking to Jeffrey Halley, Senior Market Analyst, Asia Pacific at OANDA, and David Kuo, Founder and CEO of the Smart Investor in Singapore, on Biztech's ASEAN Midday Market Watch. I'm Brian Fernandez. Check out www.biztech